episodes. We've got a pretty good list of symbols that I've got in the note card to talk about here today. Of course, I'll be looking at the chat for your questions and comments, and maybe the markets that you're even looking at. We could talk about those as well. This week, we're going to get current about some of what's happening in terms of the corrections that we're seeing in the stock market. Now, last week, you'll remember that we had a question from one of our viewers about where the stock market factors in to currencies. I mean, we always talk about the currency market being the largest market in the world. And as that, it typically is very difficult to take a smaller market and influence it because the flows are so much larger in foreign exchange and Forex. So what we want to do is talk specifically about what's happening now, not just earnings season, but sort of the depth of the correction that we're seeing in equities, because there are certain times of year, 4 times a year, where earnings are going to impact foreign exchange, specifically though, the yen and the franc. Yes, the com dollars to a certain extent, we'll talk about all that, but the yen and the franc will be the ones that are impacted the greatest. They're the ones that are most sensitive to stocks. All right. So with that being said, I need another quarantine. I need another quarantine haircut here. All right. All right. So four symbols on the watch list and what's happening with equities. First of all, what you're noticing happening in the is a pullback. If you're trading futures or stocks, and Forex is another one of the markets that you trade, please don't panic about what you're seeing right now. In fact, not that we know past behavior is any indication of what we're going to see in the future, but let's talk about patterns and let's talk about probabilities, because that's what we as traders of any market do, including Forex, where I would say because it's more 24-hour and it's so vast, patterns and probabilities play out even better there. All right. Back on June the 11th, so last month, we had a pullback. We had a correction, a dramatic sell-off, really, that just jarred all the bulls. Because remember, there's a complacency that happens in asset bubbles. People really are not calibrated in any way to a market going down. And you might say, gosh, that sounds like something a child would kind of, you have a lot of behavior right now that is reflective of, oh my gosh, the markets haven't been this low since last Monday, that kind of thinking. That's all right. That's very indicative of the kind of environment, the asset bubble that we're in right now. But those of you with cooler heads and knowing the process of the market, patterns and probabilities will say, I've seen this in June. I saw the way the markets reacted when there was a sell-off. What did we see in the Forex world? We saw some com doll weakness, meaning Australian dollar, Canadian dollar, New Zealand dollar. We saw a little bit of weakness there. We also saw yen strength, and I'm trying to remember if we saw a bunch of franc strength or not. I mean, the franc has been so strong anyways, but we did see yen strength. We did see franc strength. So when the markets are going to be reacting to equity, global equity inflows, strong stock market, or outflows, weak market, we're going to see the com dolls and the Swiss franc, and especially the yen respond. So, to no surprise, the 4 markets that I have for you today to keep an eye on in terms of corrections are the New Zealand dollar, Japanese yen. These are all daily time frames, by the way. New Zealand dollar, Japanese yen, Australian dollar, Japanese yen, New Zealand dollar, US dollar, and Swiss franc, Japanese yen. Now, in our simpler Forex, or I should say our simpler trading Forex mastery, we've been playing actually all 4 of those symbols with recent entries in Swiss franc, Japanese yen. And I'm looking to do that again. So the equities correction we're seeing is going to give us an opportunity to take advantage of probably more specifically your New Zealand dollar, Japanese yen, your Australian dollar, Japanese yen, Australian dollar, US dollar, and Australian dollar, New Zealand dollar, because those 2 com dolls, the Australian dollar and the New Zealand dollar, are going to pull back, they're going to move lower as the equity markets are also moving lower. So it's a sympathetic or more symbiotic correlation. right? So stocks and com dolls tend to be pretty sensitive to each other, moving together. Now, I guess the bigger question is, Rog, how do you feel so confident that this is going to be just an equities correction? Well, one of the things that us Forex traders keep an eye on is the central bank activities. And one of the things that we know is happening right now is that last week we saw an uptick in the Federal Reserve's balance sheet. We could talk about a lot of other macro. We could talk about trends. We could talk about technicals. We could talk about earnings and congressional hearings on Apple, Amazon, Facebook, Google. But at the end of the day, it doesn't matter. Are we going to get another stimulus package? Yes, but it's not going to have necessarily the oomph that the previous ones did. Are we going to continue to see disappointing data in the US and abroad? Yeah, we're going to see that too. Parallel with that, we're going to continue to see the central banks, including the US central bank, continue to keep rates low. They have to, otherwise this whole house of cards comes falling apart, tumbling down, as they say. And they're going to keep expanding their respective balance sheets, which is to say, injecting money into the system. Now, we kind of joke, we have this figurative conversation about the printing press. This isn't printing money. This is actually hitting a button on a computer and digitally making the money available. It's just digital money. It's not, ink and cloth. It's not bills being printed. We kind of joke about the printing press going brrr, right? It's not really. It's just a click of the mouse by the Federal Reserve, by different central banks, and it expands the amount of dollars that are available in the system. So as long as that is out there, as long as we still believe that the Federal Reserve and central banks around the world are going to continue to buy treasuries to keep interest rates low, as long as they're going to continue, like the U.S. central bank is, buy high-yield corporate debt by way of the HYG ETF, by junk by way of the JNK ETF, and another, I believe, 3 ETFs that they're buying. Why would the equity markets think that the Federal Reserve is not backstopping their play, their long play? That means com dolls, Australian dollar, Canadian dollar, New Zealand dollar, they're clear for takeoff, continued takeoff, right? And the yen is going to continue to weaken. So when we see the inverse of that happening, com doll weakness, yen strength, we capitalize on that by taking advantage of the trend. At the end of the day, gang, we're just talking about following a trend, all right? Okay, so just directionally for those of you that may not be sure, like, okay, Rog, I get the 4 symbols, but what's the play? It is a long New Zealand dollar, Japanese yen play, long Australian dollar, US, long New Zealand dollar, US, and long Swiss franc, Japanese yen. And you might say, Rob, what if you want to get short the US dollar? In this environment, I actually currently do. Because these aren't longer term plays. I'm not looking at this for 6 and 8 months and 10 months and a year down the line. This is a trend that I'll continue to take advantage of for at least a foreseeable future, as long as the markets remain heading in that trajectory. You'll notice that I still don't have euro buys, despite the US dollar weakness. You'll notice that I still don't have euro buys on our watch list. I really haven't talked about that inverse correlation between the US dollar and the euro really at all. And the reason for that is because I think most of what's driving those pairs, because you'll notice something kind of similar about all of them. They either are shorting the yen, New Zealand dollar, Japanese yen, or Swiss franc, Japanese yen, or they're long the New Zealand dollar, or they're long the Australian dollar. I'm really not playing the US dollar directly, right? I'm really not playing, even to a certain degree, the franc that directly either, although it's been very, very strong. Let me give you a little bit of warning about the franc. The Swiss National Bank, which is a central bank for the Swiss franc, hates a strong franc. They hate it. So whenever I'm long franc, I'm going to be a little hesitant. This has been even when I was trading Swiss franc futures, back when I was trading Deutschmark futures. So way before the euro and even before the Forex markets were available in the US, which was late 1999, early 2000 to retail traders. So because the Swiss franc is very secretive, because we don't get a lot of data, because we don't get a lot of monetary policy projection and warning, I am always very hesitant to have longer term franc long positions. Franc short, no problem, right? Swiss franc weakness, the Swiss National Bank is never really concerned about that. But if we continue to see this rate of franc strength, we're not going to get a warning. We're not going to get a shot across the bow. We're going to get a sudden, quick, and usually pretty extreme decision from the members of this SNB, Swiss National Bank, and they're going to do their best to weaken the yen. Right? And they do a pretty good and sometimes very violent job at doing that. Some of you might remember previous franc devaluations, especially when the Swiss National Bank unpegged the franc from the euro. A lot of you remember that. That was a 14 or 1600 pip move. It actually certainly hurt a lot of traders, but it actually put some brokerages out of business, right? Even the brokerages were caught off guard. Even they were dancing backwards in high heels on that particular move. All right. So again, just to sort of sum up here, I don't believe the pullback in the equity markets are going to be sustained. Patterns and probabilities. We saw this in June on the 11th, and I think around the 28th as well. So we've seen two pullbacks of this nature in June. This is really the first significant one in July. It took a long time to get here, over 3 weeks. So the patterns and probabilities are what? When we pull back in uptrends, we play the pullback to the long side. Will it stop working at some point? Yes, at some point we will break the uptrend and the market will move into distribution, not a downtrend, but this choppy distribution market. When that happens, the clarity that we're seeing in the currency markets will probably start to get a little bit muddy, unfortunately. But I don't see that happening anytime soon. So the next question is, well, Rag, when do you think this might happen? And I'm thinking this won't happen until probably after or near the election, the U.S. election. So I'm talking about November. October, I'd start to, heads up in October. If we're going to start to see insolvencies, bankruptcies in the U.S., I think that's also going to be a Q3, Q4 conversation, late Q3, early Q4 conversation. And that might actually start to benefit the U.S. dollar. So a lot to think about, but through summer, gang, I'm going to stick with these particular trades. It's kind of been not a holding pattern, but we've been sticking with the trends that have the best clarity right now. Please have the patience to wait for the opportunities for pullbacks in those markets. And that's when we can pounce on these on the daily time frame. Now, something for those of you that have been interested in the Forex Mastery, again, you can check that out over at simpletrading.com/FX. And the thing that I want to mention here is that we're going to shorten the time frames up a little bit. We're going to start looking at 60-minute time frames and even 240 or 480-minute time frames and look for some of the smaller, I won't say smaller by way of 240 and 480 because that's still a pretty long time frame and it's going to be more of a proxy to what I'm looking at the daily. But we're going to look at some 60-minute time frames and get a little bit more nimble about some of what we're seeing in an effort to catch some of the smaller corrections and some of the smaller moves. So shorter time frame, shorter opportunity window, but certainly we can look for opportunities in those markets. All right, so that is it for this episode. All right, and as always, I appreciate the time and look forward to seeing you guys in the next episode. I'll see you guys next Friday.